Something is changing inside the COMEX silver delivery system right now, and the change is not subtle, it is not ambiguous, and it is not the kind of thing that sophisticated precious metals investors can afford to ignore for another week while they wait for mainstream financial media to catch up and explain it to them. Because by the time mainstream financial media is explaining COMEX silver delivery dynamics to retail investors, the move that those dynamics were signaling will already be well underway and the best entry points will already be history. That is not how this community operates. We track the delivery data in real time, we understand what the changes mean before they become obvious, and we position accordingly. So let's get into exactly what is changing in COMEX silver deliveries right now, why it matters more than almost anything else happening in the silver market at this particular moment, and what it tells us about where silver is heading next. Start with the foundational question that every investor new to COMEX delivery tracking always asks first: why do delivery statistics matter at all? If you already understand futures market mechanics deeply, bear with me for 2 minutes because this framing is important for understanding why the current changes are significant rather than routine. COMEX silver futures are legal contracts obligating the seller to deliver and the buyer to accept delivery of a specific quantity of silver, 5,000 troy ounces per standard contract at a specified time and place. If the contract reaches its delivery period without being closed out or rolled to a future month, the vast majority of silver futures contracts never result in actual physical delivery. Most are closed out by the time delivery becomes obligatory. The long sells their position, the short buys theirs back, and the two positions cancel each other out with a cash profit or loss but no silver changing hands. The futures market functions primarily as a price discovery and risk management mechanism rather than a physical distribution system. And this is the critical, but the possibility of physical delivery is what anchors the futures price to the real physical market. Without the delivery mechanism, futures prices could diverge indefinitely from physical silver prices with no market force to bring them back into alignment. The delivery mechanism is the pin that connects the paper market to reality, and when that delivery mechanism shows signs of stress, when the statistics around who is delivering, who is standing for delivery, how much silver is changing hands physically, and at what pace it is telling you that the connection between paper and physical is being tested in ways that have direct and powerful implications for price. Now let's talk about what is specifically changing in the delivery data right now, because the pattern that has been emerging across recent delivery sessions is not a random fluctuation. It is a directional shift with specific characteristics that experienced COMEX watchers recognize as significant. The first change is in the total number of contracts standing for delivery relative to historical norms for this point in the delivery cycle, when more contracts than usual are standing for delivery, when the open interest that survives into the delivery period is larger than what seasonal patterns and historical averages would predict. It tells you that a higher than normal proportion of long futures holders are choosing to take physical silver rather than rolling their positions forward to the next contract month. That choice, the decision to take physical delivery rather than maintaining a paper position, is not made casually by serious market participants. It involves the operational complexity of vault designation, the capital requirement of paying full contract value rather than maintaining a leveraged futures margin, and the carrying cost of storing physical silver. Entities that make this choice in size are doing so because they believe the physical metal is worth acquiring directly, because they have a use for it, because they believe physical silver is undervalued relative to the paper price, or because they are concerned about the long-term reliability of purely paper silver exposure. Each of those motivations is individually significant. The combination of all three driving delivery demand simultaneously is extraordinary. The second change showing up in the delivery statistics is the identity profile of entities taking delivery, and while the COMEX does not publish individual names in its real-time reporting, the category classifications in the delivery data reveal patterns that are genuinely informative. The breakdown between commercial entities, industrial silver users, mining companies, physical dealers and financial entities, investment funds, trading houses, bank proprietary desks, tells you something fundamental about the nature of demand driving the delivery activity. When deliveries are being dominated by commercial category participants, it suggests that the physical supply pipeline serving industrial silver users has tightened to the point where COMEX delivery is becoming a necessary sourcing channel rather than a last resort. Industrial companies that are taking physical delivery from COMEX are doing so because they cannot source the metal they need efficiently through their normal channels. And that breakdown in normal supply chain functioning is a direct real-world signal about physical silver availability that no amount of inventory data analysis can convey more powerfully. When financial category participants are driving a significant share of deliveries, it raises the additional question of strategic positioning. Are these entities taking physical silver because they anticipate that physical availability will become even more constrained, making direct ownership of vault-stored metal more valuable than paper claims? That kind of forward-looking physical accumulation by financially sophisticated entities has historically been an early indicator of major supply stress before it becomes visible in headline prices. Go ahead and hit that like button and subscribe to this channel right now if tracking this level of detail in COMEX delivery data is exactly the kind of market intelligence you have been looking for, because this is what we do for this community every single week, and we are just getting started. The third change in the delivery data that deserves specific analytical attention is the pace of daily delivery activity within the delivery period itself. COMEX silver deliveries do not all happen on a single day. They are distributed across the delivery period, with first notice day marking the beginning of the window and last delivery day closing it. The daily cadence of delivery activity, how many contracts are being delivered each session, whether the pace is accelerating or decelerating as the delivery period progresses, and whether there are any unusual single-session delivery spikes tells you about the urgency and organizational characteristics of the delivery. Demand. A delivery period that starts slowly and accelerates where delivery activity picks up as the window progresses suggests that demand for physical silver is growing as the delivery period unfolds, potentially because initial deliveries revealed tighter physical supply conditions than anticipated and triggered additional delivery. Demand from participants who were watching a delivery period with large single-session spikes where an unusually high number of contracts deliver on a specific day often reflects a single large participant making a deliberate, coordinated move to accumulate physical silver in size. Both patterns are visible in the daily delivery statistics, and both carry information about the nature and urgency of physical demand that the aggregate monthly delivery total alone cannot reveal. Let's connect the delivery picture to the registered inventory dynamics that we have been tracking with particular intensity, because these two data streams are deeply interrelated and understanding their interaction is essential for building a complete picture of the current silver supply situation. Registered silver inventories. The metal designated for delivery in COMEX vaults are the physical pool from which deliveries are made. Every contract that stands for delivery and results in the transfer of physical silver draws from that registered pool. When delivery activity is running at an elevated pace relative to historical norms, registered inventories face drainage pressure from two directions simultaneously, from contracts delivering out of the pool and from the potential failure of new metal to flow into the pool at a pace sufficient to offset the outflows. If eligible to registered conversions, vault owners choosing to designate their metal for delivery are keeping pace with delivery outflows. The registered pool remains stable and the delivery activity, while elevated, does not create acute supply stress. But if conversions are lagging, if the registered pool is declining despite or because of elevated delivery activity, then you are watching a genuine physical supply constraint develop in real time. The gap between delivery outflow pace and conversion inflow pace is the most important dynamic to monitor in the current COMEX silver data, and it is a gap that is changing in ways that the data right now makes impossible to ignore with intellectual honesty. Here is something that gets to the heart of why tracking delivery changes matters so much at this specific moment in silver's larger story. We have spent multiple videos building a comprehensive structural case for silver: the gold-silver ratio reset, the real interest rate indicator firing, the industrial demand revolution from solar panels and EVs and semiconductors, the IMF's macro intervention and its transmission into precious metals, Powell's policy signals and their implications for real yields, the post-options expiration technical reset. All of that analysis has been fundamentally driven looking at the big picture forces that determine silver's value and trajectory over months and years. COMEX delivery data is different. It is the real-time physical manifestation of those fundamental forces showing up in the most concrete and verifiable form possible. When the structural thesis says silver should be in growing demand due to supply deficits, and then COMEX delivery data shows delivery volumes running above historical norms with registered inventories declining, the delivery data is not just confirming the thesis. It is showing you the thesis playing out in the actual movement of physical metal between vaults, theory becoming reality, paper analysis becoming physical fact. That validation of a structural thesis through observable physical market behavior is one of the most powerful and most confidence-building confirmations an investor can receive. It is happening right now in the COMEX delivery statistics. Let's talk about what the changing delivery picture means for the specific near-term price scenarios that silver investors should be preparing for. The first and most immediately relevant scenario is what happens if delivery activity continues to run at elevated pace while registered inventories continue to decline without sufficient conversion flow to replenish them. In this scenario, which the current data trajectory makes increasingly plausible rather than speculative, the market eventually reaches a point where the supply of registered silver available for delivery is insufficient to meet the remaining delivery demand without a significant price adjustment. That price adjustment, the market's mechanism for rationing physical silver when supply is constrained relative to demand, takes the form of rising prices that either attract new metal into the registered category by making conversion economically compelling, or reduce delivery demand by making physical silver expensive enough to discourage marginal buyers. The speed and magnitude of that price adjustment depends on how severe the gap between delivery demand and registered supply becomes before the market self-corrects. Given the trajectory of the data right now, that gap is narrowing rather than widening, which means the timeline for when price has to do the work of market clearing may be shorter than many market participants currently appreciate. The second scenario worth preparing for is what happens in the wake of the current delivery period as the market transitions to the next contract cycle. Delivery periods end, the contracts expire, the physical silver that has been delivered settles into the hands of its new owners, and then the market resets for the next cycle. New contracts, new open interest building, new delivery period approaching. What matters enormously for the next cycle is where registered inventories stand after the current delivery period clears. If the current delivery activity has drawn registered stocks down to particularly lean levels that leave the COMEX system with limited physical buffer going into the next delivery period, then the stage is being set for compounding pressure. Each delivery period that draws down registered stocks without sufficient replenishment makes the next delivery period potentially more stressful than the last. That sequential, compounding nature of delivery pressure is exactly What characterized the COMEX silver market in the lead up to the most dramatic price events in its history? Watching where registered inventories settle after the current delivery period closes is therefore not just important for assessing the current situation, it is critical for projecting the trajectory of physical supply stress going into subsequent months. Now let's address the cross-market dimension of what the changing COMEX delivery picture means, because silver is a global market and COMEX delivery dynamics do not exist in isolation from what is happening in London, in Shanghai, and in the physical retail markets of Asia and the Middle East. The London OTC silver market, the LBMA system, is the world's largest silver trading venue by volume, and it operates on a different physical settlement mechanism than COMEX. But the two markets are connected by arbitrage flows and by the global pool of above-ground silver that serves both systems. When COMEX delivery demand is elevated and registered inventories are under pressure, arbitrageurs look at whether silver can be sourced more cheaply from London and transported to COMEX vaults to meet delivery demand. If that arbitrage is functioning smoothly, if silver is flowing from London to COMEX to fill delivery requirements, it suggests the global physical supply pool is adequate to meet both markets' needs simultaneously. But if the London to COMEX arbitrage flow is sluggish or insufficient, if silver is not moving from London to New York fast enough to offset COMEX delivery demand, it signals that the tightness in physical supply is not a COMEX-specific artifact but a reflection of genuine global scarcity. The premium or discount at which COMEX silver trades relative to London spot silver is the market's real-time signal about which direction this cross-market physical flow is running. A COMEX premium over London silver costing more for immediate COMEX delivery than for London spot tells you the arbitrage is not keeping pace with COMEX demand, which is one of the most direct signals of genuine physical tightness available in real-time market data. Here is the broader investment implication of everything the changing COMEX delivery data is telling us, stated as clearly and directly as possible. The delivery statistics are the place where the entire structural silver thesis, all the fundamental analysis, all the macro signals, all the ratio dynamics, all the industrial demand projections ultimately has to show up if it is real and not just theoretical. A structural bull case for silver that is not eventually manifesting in physical delivery dynamics is a bull case that is struggling to connect paper thesis to physical reality, but a structural bull case that is showing up in physical delivery dynamics that is visible in elevated delivery volumes, declining registered inventories, commercial entities sourcing from COMEX because normal supply channels are insufficient, and a London COMEX spread that reflects genuine cross-market physical demand is a bull case that has passed from theory into observable market fact, and observable market fact, in the form of actual physical silver moving between vaults at an elevated pace, is the most durable and most credible foundation for an investment thesis that anyone can have. The delivery data right now is not screaming. It is not creating the kind of dramatic, visible supply crisis that makes front-page financial news and triggers mass retail FOMO. What it is doing is something that in many ways is more valuable to informed investors who are paying attention. It is building, consistently, directionally, persistently building toward a supply picture that fewer and fewer market participants will be able to dismiss as they watch each subsequent data release. That building pressure, visible now to those who are tracking it, invisible still to the majority who are not, is exactly the kind of developing story that creates the most significant investment opportunities. The delivery statistics are changing. The trajectory matters more than any single data point, and the trajectory right now is telling you something very specific about where the silver market is heading. Leave a comment right now and tell us, are you tracking COMEX delivery statistics as part of your regular silver market monitoring, or is this the level of detail you are adding to your analytical framework for the first time today? We want to know how this community is evolving in its understanding of physical delivery mechanics, because your answers shape how deep and how technical we go in future videos on this topic. And if you know a silver investor, someone holding physical silver, mining stocks, or ETFs who has never looked at COMEX delivery data and does not understand what the current changes in that data are signaling, share this video with them right now, because the investors who understand delivery dynamics before they become obvious are the investors who are already positioned when the move that those dynamics are pointing toward finally arrives. We will see you in the next one.